welcome everybody. We'll let a few more people come in, but we'll get started here. I have, our investment gurus. How lucky are we? We have Nic and Shaun on here today, this afternoon, to go through our, June webinar series. And today we're going to discuss everything beyond traditional markets, right? You hear a lot of things in the media and maybe your coworkers talking or people, your family members talking about PE, so private equity. So we'll go through kind of what that means, some alternative investments, how does that impact investors? And I think the important part is talk about specific examples and what we've seen clients go through and questions that we see. So with that, I'll kick it off to Nic and he'll dive right in.
Yeah, perfect. So, yeah, my name's Nic. I'm the CIO here, as Nora said, and thankfully we have Nora today instead of Bob, so we can just disregard his picture there. And then we also have Shaun with me, just to add a lot more of what he's experienced with clients and how he approaches it when he's having planning conversations of how private equity fits into the puzzle. So. Today's roadmap, we have a lot. I promised Shaun to keep it under 2 hours, so we'll go through this quickly. But step one, or the first thing we want to talk about, is defining the universe, which sounds very ominous. We'll get into that. But then just giving a good 101 level foundation for what private equity is, how it works, and then knowing the trade-offs between just private equity, all alternative investments, and if they make sense for you or not. And then really the planning lens, because that's ultimately probably one of the most important pieces of this whole equation is how does it fit for me or does it fit for me? So anyway, we're gonna kick it off here, but without any further ado, defining the universe. So we're gonna be here for a long time. No, just kidding. Usually, when we talk about investing, we're talking about public market stocks or publicly traded stocks. So that's the ownership of publicly traded companies. When we're talking about bonds, those are publicly traded bonds, usually from those companies or from governments. So it could be like US Treasuries or Treasury bonds from other countries. And then we always talk about cash too. So this is what we'd call like a traditional kind of core portfolio, stocks, bonds, cash, playing a role there. And then when we start to look at the world of alternative investments, we add another slice to the pie here. And that is a really wide umbrella. It can mean a lot of different things. But today we're going to spend most of our time talking about private assets, specifically private equity. But this is really just that's just one piece of what could be in this category. So there's real estate, physical. We've done a webinar already on 1031 DSTs, could be private REITs. There's hedge funds, there's insurance related things, everything from annuities to structured notes or buffer ETFs. There's precious metals and crypto. I know those have had a lot of conversations around them lately. And then also just stock concentrations, which even though like normal stock concentrations, that could be publicly traded stock. We have a lot of clients who are employees at a publicly traded company, and so they have RSUs or employer stock that's restricted. Or sometimes people have a large inherited stock position that we almost treat as an alternative as well, just because it's has a lot of unique risk to it. So anyway, this is what a portfolio could look like if you're layering in alternative investments. It could mean any number of these different things. So, all
And I
right.
think a key highlight here is when we talk about traditional, think of like your Coca-Colas, right? A
Mhm.
big brand name company that files a report with the SEC every quarter. They're mandated to do things. As soon as you get into that private space, a lot of those rules kind of go away. And so you don't have everyone being as forthcoming. Things are a lot harder to evaluate, which we'll kind of get into. But understand like the public companies are kind of typically those larger companies, and then those private ones can be smaller or kind of a conglomerate of other companies that they don't have to be as forthcoming with information because it's a private strategy.
Yep. Yep. Absolutely. And we will get into that. And another key note here is alternative just means outside of the traditional publicly traded stocks, bonds. It does not automatically mean better, right? So like we have plenty of clients who are able to get from point A to point B without any alternative investments, and that's totally fine. There are some unique planning situations where people just happen to find themselves in the middle of sort of alternative investment, or sometimes people are just really interested in it and want to have this as part of their portfolio. So, anyway, alternative does not mean better. Let me just caveat that there. So, and then, as Shaun was saying, not only are there different reporting requirements, they also have different liquidity profiles. So, all those Coca-Colas or Apple stock, those normal things, those are daily liquid, meaning that we can buy, sell, trade those anytime during the normal stock market hours, which is great. But then alternatives, there are some that have daily liquidity. However, they might not give you as like pure of an exposure to those specific private markets that you're looking at. So there's trade-offs there we can get into a little bit. There are also alternative investments that have what we call it periodic liquidity, interval funds, interval meaning that there's liquidity available in different intervals throughout the year. Annuities, I kind of count in the periodic liquidity category. But the key thing here is that redemptions may be limited or not available in stressed markets. So just because it's usually periodic doesn't mean always. And then lastly is what we call locked up capital or illiquid private investments. And these are truly private placements and there's pros and cons to that we'll get into. You can get into a little bit more niche things. But again, these are long-term illiquid commitments. So they are certainly not for everyone. All
And
right.
I'll kind of jump in here too with some stories, right? So
Mhm,
clients that I've seen that have kind of bought into these, typically outside of what we're doing,
mhm.
they buy something and they don't necessarily understand this part of it. So they're used to saying, "Hey, I need to make a withdrawal." We make some trades, we sell whatever ETFs, mutual funds are in. We're able to get them cash. When you buy some of these alternative or private equity placements, all of a sudden you want your cash and it's not available because you signed up for a contract and that may be an interval, like Nick talked about, where, hey, you got to wait till next quarter. And at that time, they don't have to give you everything that you request. They can say, hey, we're only doing a partial liquidity event right now. So I know you requested 10,000. We may only give you 5,000 or maybe not anything. And that goal line has changed before. So, hey, you sign up. Our plan is to get you this money in 5 to 7 years. Oh, what do you know? We've been acquired by another fund. We're going to go ahead and change the liquidity timeline. So now that you can't get money out of it, and so that tends to lead to a lot of people's frustration when they buy some of these investments is I didn't know that I could get my money back, or I was planning on getting it back in 5 years, and the goalpost shifted. And so that's a key thing to kind of understand is when I'm signing up for this, the devil's in the details of when I may be able to get my money back, how I'll be able to get it back, and kind of the transparency of when that time period will end. So keep that in mind when you're getting involved in these type of investments.
Yeah, absolutely. Like the goalpost analogy. Sean hates it when those goalposts moves back, the football background. But yeah, and even if like let's say you wanted to access private equity or private real estate or just real estate in general, right? Whether you access it through ETF or an interval fund or a true private placement or you go buy a house, like your experience is going to be totally different depending on what method you go about it. So yeah, so just because somebody says like, oh, I invest in real estate, that could be a lot of different things. Same is true with private equity or and even insurance or other things like that. So yeah, we'll keep it going along here. So specifically double clicking into private equity here. And I think one of the main reasons we wanted to push this webinar up to today is there's been so many headlines this year about the crazy IPO market, which IPO market's been like quiet, dead for probably since before COVID, like 2019 or before. And so this is kind of the first sign of life in, 6 or 7 years. And it's got everyone thinking like, hey, maybe I wanted to invest in these companies. Maybe I should do it on the IPO. Maybe I should do it before the IPO. Maybe I should do it after. But the reality is like there are opportunities in private markets. Like all of these companies on the screen are currently, well, except for SpaceX, are currently privately held. And so it's like, well, what if you wanted to get exposure to those? What's one to do? And then the other reason it's kind of top of mind for folks and should be top of mind is just in general, there's far fewer publicly traded companies today than there were in the 90s. Like almost half is what the number is, like 3,500 versus, about 7,000. So it's like, where did all these companies go? It's like, well, some of them just went out of business, which is natural. Some of them were taken private. But in general, a lot of newer companies have chosen to remain privately held instead of launching into the public markets early on when they're small. And a big reason for this is because private equity firms have stepped in and been able to offer the original founders, the original entrepreneurs, a lot of liquidity and kind of giving them that big payday while it's still public, or sorry, while it's still private, without them having to take it public. And so they're like, hey, well, I got my money, and now I can still have more control of my company as it's private. So maybe I don't need to deal with all the headaches of quarterly reporting and the SEC and all that. And so what's happened is of all of the US companies that have at least $100 million in revenue, so like big US companies, these are not, as I always say, these are not the deli shop down the street. Like these are big, big companies. 87% of those are privately held in the US and only 13% being public. And so it's like, hey, maybe there's some opportunities in that 87%, right?
And I think also we're seeing a lot more clients who work for a firm, and sometimes it is a large firm, and they're saying, "Hey, I'm being bought out by private equity. My firm's being bought out by private
Mhm.
equity. How is this going to impact me?"
Yeah.
And so a lot of times those private equity firms come in, they give the owners, as Nick talked about, a big chunk of money, and then their plan is to sell it in 5 to 7 years, a bunch of growth on it. A lot of times we see them cut back 401k benefits, cut back some other benefits, increase the profitability, and their goal is typically to resell it. And so when Nick kind of talked about an IPO, that's an initial public offering. Some of those companies have been private. They haven't had to go through the reporting requirements. They haven't had to have a board of directors. All of a sudden, they go public for the benefit of getting a large amount of cash from this new pool of investors, us common folk. And then we make the investments. They get a bunch of money, and they now have all these reporting requirements. They all have the board. And we've seen people like Elon Musk be threatened to kick off his board, even though he owned the company. And so owners are seeing that and saying, hey, let me just stay private. I don't have to deal with a lot of that hassle.
Yep. Yep. Yeah.
And a
Absolutely.
good question here, before we kind of move on, Nick, if you want to kind of elaborate on that graph to the right. Question came in is that 87% of the market cap or 87% of the actual number of companies?
This is the actual number of companies because yeah, I thought about the same thing too with like SpaceX in particular, OpenAI, these trillion-dollar companies. Like, oh, well, it's like just those few companies. No, this is like the sheer number of companies, not market cap. So great question. So, all right. I will keep it moving here. So another, I'm going to say like take this graph with a grain of salt too, but it's also very interesting. This is looking at just Hamilton Lane, which studies and does a lot of deep dive reports on private equity and how it compares. And if like firsthand experience going out and trying to find like how has private equity, quote unquote, performed versus public markets, it's actually very difficult. You get a lot of different answers. And the reason for that is there's not like a single index or there's not like a single fund that represents private equity as a whole. And so what happens is these people that do these back tests and try to study it, they have to piecemeal together like, okay, we're taking this category and this category, we're stripping out the bond investors, we only want to look at the equity investors. And so this was their best attempt at recreating the private equity market's performance over the last 20 years or so. And they've done a lot of other studies on it. I'm not going to go into all those. This is just kind of the high level chart. But the main thing is this is an annualized 10-year rolling return. And so um, I would say like it's very the darkest line there is private equity. The next closest line is the S&P 500. you'll see like they are very closely correlated overall, right? Like private equity has outperformed, but it's not like doubling the S&P 500 or anything like that. Like it might do a few percent better every year on average. But again, that comes with a lot of trade-offs, and that extra few percent of return may or may not be worth it, depending on the situation. So, say like there is outperformance opportunity there. There's a lot of trade-offs along the way. And looking back at any data on private equity, there should always be asterisks, grain of salt on how that data is compiled. So, okay. All right. So taking a step back, I realize we've said the word private equity probably 50 times already on this webinar. What is that? Private equity is money invested in companies that are not publicly traded. So this could be anything from you could go put some money into a deli shop down the street. It could be a company like Anthropic or OpenAI, some of the biggest, trillion-dollar private companies today. Those all kind of fall in the same category of private equity. So it's a very big category when we're talking about this. So to kind of break it down, there are four main segments. Again, there's not even a standardized way to describe it. I'm going to say there's four main segments within private equity that you could invest in. And then there's a bunch of different ways to access those segments. And so we're going to go into both of those there just to give a better lay of the land. So first things first, venture capital. I think most people have probably seen an episode or two of Shark Tank, and you're like, hey, that looks really fun. I want to invest in these small companies. And usually on Shark Tank, it's somebody had an idea. Sometimes they have revenue, but really they're going to the sharks to look for, they're willing to give up ownership in their company to kind of launch them into the next level of scaling. And these are super high risk. I high risk, high return opportunities. A lot of those companies from Shark Tank never turn into anything and they write those $1 million checks for nothing. But sometimes they do hit it big. And in fact, most of the venture capital has like a 90% failure rate where like not going flat, like your dollar is going to zero because the company failed. And so it's like, all right, but there are some that hit 10x. Okay. Growth companies, kind of the next step up of maturity, is medium risk. This is kind of what, these are revenue positive companies. It's more than just an idea. They have real sales, but now they're really needing like a bunch of capital to take it to the next level. Buyout, these are considered lower risk in the realm of private equity, not like lower risk in absolute terms. Like this is a private equity investment. All of these are considered high risk to a degree, but these are less risky in the buyout category because these are usually more mature, cash flow positive companies. And this is a lot what the scenarios that Shaun was talking about, those private equity firms buying out the company, trying to, shake it up, make it more profitable, and then going to turn around and try to sell it again in 3 to 7 years or something like that. So that's called buyout. And then there's special situations. Sometimes you hear private equity in the news doing something crazy, and you're like, what is that? And that could be a bunch of different things. Kind of lump those all together into special situations. So those are usually like if there's a company facing bankruptcy or something, a private equity firm can come in, reorg the company, and then try to right the ship and make some money on the back end of that. So these are the categories as a whole. Again, when we talk about how is private equity performed, it's looking at all of these different categories. So obviously venture capital would have the most volatility, right? Have the most chance of things going to zero, but also some good ones, and all the way on down. Okay. So just to put like a few names to it, because it's helpful, some talking in abstract. So venture, Uber in 2011, Benchmark Capital did an early investment when it was just an idea of a ride hailing app. And that obviously has grown into a giant company. SoftBank did a big investment into DoorDash in 2018-ish and gave them money to just scale their platform into a bunch of different markets, a bunch of different even countries, And then shortly after, DoorDash IPO'd, I believe in 2020. So this was like a pre-IPO type of private equity move. But then they were looking to get their liquidity through the IPO phase, right? SoftBank's looking to get their money back, largely by turning it into a public company. Buyout. This one is interesting. Dell is obviously publicly traded today, but in 2013, Michael Dell and Silver Lake took it private because it was struggling, and they changed a bunch of things, made operational improvements, restructured the business, and then turned around and made it public again, I think like 5 or 6 years later. So Dell's an interesting one. And then Hertz, Rent-A-Car, special situation. Apollo Global Management was very active in the Hertz bankruptcy. And while they were going through bankruptcy, Apollo was reorganizing it, redesigned the company's capital structure, and then took it back to public markets and is trying to, still turn the ship around there, but at least got it out of the bankruptcy phase. So private equity can have their hands in a lot of different areas. And depending on what your goals are, depending on what you're interested in, et cetera, might guide, which segment we lean into the most for you. Okay.
And I'll point out some situations that maybe aren't as big, right? So things that we've seen with clients is a venture capital might be, hey, I've got a family member or a friend who's come up with a new product. I'd like to pull some money out and give it to them and be a part of their business and help them grow. And so it doesn't always have to be, a big company or a huge private equity firm coming in. It can be as simple as a loan or trying to buy in, help a family friend. Or you've got someone who's got a business, they're growing, they're looking for capital. And so, they are trying to continue on their growth. So you buy in that way as well. I've also seen people buying into things like storage units or, doctors are doing satellite surgical centers or different satellite ER facilities, and they get opportunities. So a lot of times people hear about a friend jumping into something and they want to be a part of it because it's fun and it sounds really good. And I always say you got to use some caution there because when you buy in through a mutual fund that owns private equity, there's at least some reporting requirements. You can log into, Charles Schwab or Altrist or whatever your custodian is and see that your money's actually been invested there. When you get into, hey, I want to buy some storage units and hey, my friend has been doing this and they've been getting checks every month or every quarter, so it must be working. We also have seen those things turn into Ponzi schemes because you're not able to log into a custodian, see where your money's being invested. It's not being reported through the SEC. It's not being done through a mutual fund. You're just believing whatever presentation you received, and you start getting some checks. But I always caution if you can't verify that that money's not sitting in that person's bank account, you have to be very careful because those things still happen in 2026. You would be surprised at how many people have fallen for things like that. And I think every time a new technology comes out, in artificial intelligence and crypto, it allows for fraudsters to have new opportunities to fail people. So just because someone makes a presentation to you, other people are doing it, doesn't mean it's a good idea for you. And so I've seen a lot of those things happen. And kind of our advice, if like, hey, I'm going to do a family loan or something like that, or if give some money to a friend, is there just has to be enough money that you're not going to destroy your family's wealth, right? If you want to
Mhm.
do that because it's going to be fun for you, you want to help your family or you want to help the friend, you got to be willing, as Nick said, for that to go to zero, right? Those are the kinds of people that should be getting involved in venture capitalism, where they're cutting off a small percentage of their portfolio to take a gamble, and if it goes to zero, they can laugh about it. And if that's not the case, then some of those smaller placements are probably not going to be the best idea for you. Obviously, something like a Dell or Hertz or an Uber or a DoorDash, like you're using that on your phone. There's revenue, there's things happening there. Much different than kind of getting into the small family business or a friend's business as well.
Yeah, totally. So true. And it's so funny how like these all fall in the same category of private equity, right? It's like it could be a business with $10,000 a year of revenue, or it could be a business with $100 million a year of revenue. So, yeah, and it's important to do your due diligence on all of those, no matter how big or small. So, some investment vehicles, ways to access those segments outside of the stuff that Shaun just said. Like, you could obviously write a check to a family member or friend and kind of hope for the best there. But on the like institutional side, there are a few different ways to invest. So number one is fully liquid vehicles. So there's already, this is actually all of everything in the fully liquid category, I would say is like very new within the last few years. So public ETFs or mutual funds now are able to have a certain percentage of their portfolio in private equity. And so we saw this a lot with SpaceX. There's quite a few funds that had like 10 to 20% of the ETF in a SpaceX position. So that's interesting, kind of a new development there. We're still seeing how that works out for them long run. And then these other two on this are like I would say like bleeding edge, super new, not like a totally legit way to go about it currently, but is a huge growing opportunity to try to help people have more easier access to private investments without having all the downsides. So prediction markets, I don't know if you've heard of Polymarket or Kalshi, but you can effectively get exposure to private equity by doing bets on like the market caps. Like right now, there's a big prediction market is ChatGPT's parent company. OpenAI, is it worth a trillion? Is it worth 2 trillion? What's it going to be IPO at? Is it going to be 2 trillion by the end of 2027? And so that's like a long dated thing that's getting you exposure to OpenAI's market cap, but it's not a stock, right? It's a betting market effectively. So that's a very interesting lane. We'll see if that grows. It's been growing. I don't know where that's going to take us. Um, Tokenized securities, that's even more on the fringe, but people trying to use blockchain technology to allow access to private equity with basically sidestepping a lot of the normal regulations around, buying into a private and making it a accredited investor and all that. So semi-liquid funds, these are usually like when folks come to us and they're like, hey, I want to invest in private equity, we usually kind of steer toward something like this. But there's a thing called the evergreen interval fund. So it just exists forever. That's what evergreen means, or just barring any terrible things happening. Um, and the nice part about that is it's just normal tax reporting. You get that semi-liquid, usually quarterly, sometimes semi-annual liquidity option. And that's usually pretty good way to get exposure to the private markets. And this whole segment of semi-liquid has just grown a ton over the last 5 years too. Like this didn't even exist as a category probably 6 or 7 years ago. So this is a good, I would say, development in the financial services, letting folks have more access to things like this. Secondaries, I don't know if you guys saw, Schwab just acquired a company called Forge last week, 2 weeks ago. And that is a secondaries platform for employees mostly who have private equity shares from their employer and they're looking to get liquidity and their employer's not offering share buybacks at that time. So they can go to a marketplace like Forge and try to sell those shares on the open market. And so that's been really interesting. I mean, it's Schwab apparently thinks it's legitimate enough for them to buy it. And so we'll see if that becomes a more common or popular platform or ways to get private equity exposure. And then lastly, this is what I would say is like the traditional private equity investment, or if you go to like a quote unquote family office or something like that, usually what they're going to be presenting is something like a drawdown fund, which essentially means you put your money in and it gets drawn down over time, which sounds like a terrible investment. But if you think about it in the lens of like they're actually putting money to work in a private business, like if somebody put, let's say there's an ice cream shop and somebody invested $10 million dollars into it, that doesn't mean on the next Tuesday that they're going to have this huge run up in sales growth, right? It takes time for the sales and the revenue to come after the investments come. So you actually see this big dip in the investment experience. Like initially you're underwater, and then hopefully if everything works out well, then you get it to the break even and above water phase. That's a drawdown fund. Those are usually 10 to 12 year long investment. So like really long-term money. And again, super illiquid. It's not easy to go back to those companies and be like, oh, I want my money back. Sorry, you're doing all this capital expenditure, building out your business. It doesn't work that way. There are now evergreen private equity funds, which is, I would say, is better than a drawdown fund, but still very illiquid. Plan on just no liquidity is usually what I tell people when you're going into something like this. Like you want to make sure that this is super long term, and if it goes to zero, it goes to zero, but it might do really well for you over the long run too. And I know I've talked a lot, but then the last category, there's been this huge explosion in the last 2 years of what are called SPVs or special purpose vehicles. And this is essentially a private limited partnership that just owns a 100%, like the only assets in the private partnership are just one company's uh, stock. So, for example, it could be SpaceX stock that's just sitting within this private placement. But the kicker with that is that there's usually a front end load, not uncommon, like a front end commission, not uncommon for that to be 10 to 20%. And there's a carry on it as well. And carry is a fancy word for a performance fee. So let's say that you made 100% on the investment, like that's great, but there's a performance fee of 10 or 20%. That means 10 or 20% of that goes back to the fund managers. And so even in the best case scenario, there are some steep costs there. And so it's really got to be worth it for you to be worth all the headache of getting into one of these things. Okay. All right. I know that's a lot. We're going to keep it going here. So bringing it together, there are different segments of private equity, and they can be accessed by different vehicles, whether they're liquid vehicles, semi-liquid, or fully illiquid. Just to like name a couple here, kind of as an example, there's this fund is a venture fund, so it's focused on the venture category only. But as you see, the holdings in it are, it's mostly SpaceX, it's mostly OpenAI, and has Anthropic in there as well. Those are giant trillion-dollar companies today, and so they've already experienced a huge moment of growth, I would say, going from when they were small into this giant state here. And so these venture funds don't always just like sell the position, as soon as it's not considered venture anymore, right? Like they're going to ride it out a little bit more. So just kind of interesting there. The Cascade Private Capital Fund, this one is basically like 25% venture and growth, and the rest of it's the buyout or those kind of more stable plays. So like that one's kind of a middle of the road. And then this KKR one doesn't have any venture. It's only those buyout type of kind of more stable plays. So just to kind of give some like real world examples of how people access these or different ways that we can help clients access these different strategies depending on what's interesting to them. So, okay. So not examples, they are examples, not recommendations for everyone. I'm gonna keep going. All right. So the trade-offs. We talked about this a little bit, but we're gonna go really deep into the risks and the downsides here because yes, there are upsides, but there's plenty of downsides as well. And it's, I would say, worth it for us to spend more of our time talking about the downsides than anything else. So, number one, illiquidity is you buy into one of these things, whether it's the interval fund or a true private placement, and if you need money in a pinch, like you're probably not going to be able to sell it or sell it at a favorable price, right? Like if you go to them, to the fund company and say like, hey, I had this very traumatic thing happen. I really need this money back. They'll be like, okay, maybe we'll give you special liquidity, but it's going to come at a 10 or 20% haircut to what you're expecting. And so it's like, oof. Again, want to make sure that we're very cautious about what we put in. Valuation uncertainty. So publicly traded, it's like, how do we know what something's worth? Because there's two people telling you, I want to buy it for this and I want to sell it for that. And that price in the middle, it's like, that's the price. In private markets, there's not really people buying and trading these things all the time. And so how do we even know what the value is? And the answer to that is private companies will go through a auditing process, and they'll get their marks periodically, which mean like it might be 3 or 4 times a year, might be 2 times a year, where they say, okay, our assets are doing pretty well. This is our current estimated value, and then that's what they report. So that's a completely different model than two people actively bidding on something and telling you what the price is. Very important there. And then there's other things too, like models. So, like, say you're invested into a private oil and gas company, and if gas prices or oil prices go up a lot, then they can kind of guesstimate, like, okay, this company should be X amount more profitable because this is where the price of oil is. And so, like, you can kind of back into it that way, but yeah, it's very, I almost say like back of the napkin, very different pricing experience than the public markets. So, and keep going on here, but leverage, totally normal for private funds to use leverage or debt to amplify their returns. And of course, that can also mean they could amplify their losses to the downside if it doesn't work out well. So, got to make sure we're watching the debt levels, fees, and expenses. Um, Pricing for everything in the private market land is generally going to be quite a bit more expensive than public vehicles. And so, like, could be 10 times more expensive than public vehicles or more. And so it's very important to make sure that, if the juice is worth the squeeze there, and that, you're going to experience some upside, not just the private equity fund manager. Concentration, we talked about it with like the SPVs. That's a single stock in a fund, right? And so you probably don't want to have all of your investment into that single stock. You might want to make sure you're investing in a diversified private equity vehicle. So if that one stock goes to zero, then your whole investment didn't go to zero, right? And then tax complexity, most of the true illiquid stuff has a K1 reporting, because you're a partner in a limited partnership. And so it's, usually a much more expensive and painful waiting game of getting your taxes done versus the more liquid stuff usually has the 1099 normal cadence of tax reporting. So, anyway, so let's say the big question is, could I stay invested financially or emotionally if this was marked down, delayed, or impossible to sell for several years? That question is the big one. That's, I think, the thing that we would ask you and that you should definitely ask yourself. And it's also hard, I understand, because, so they say it's one thing to like stand on the ground and look at a roller coaster and be like, I know how I would feel on that roller coaster. And it's a completely different experience than riding the roller coaster and feeling those ups and downs. So, anyway, that's a big, big question there for, does this make sense for you?
And I think a lot of the ways that we see people come to us from private equity is, hey, I was talking to someone at the water cooler or at the golf course or at the gym, and they're doing this, and I think I want to get involved. And all of these risks that are on the screen almost never come uh, in the question when they ask, should I do this? And this is kind of what we go through is like, you're not going to know what the fees and expenses are. They're going to be, they could be really high. It's going to be hard to get your money out, and it's going to be challenging from that standpoint.
Mhm. Yeah, nobody talks about this stuff at the water cooler, right? Come on, that's not fun.
Yeah, and I think to that point, a question did come in is if you were approached, it says, if I was approached by a friend or business regarding an alternative investment, what are some of the general questions I should initially ask before
Mhm.
committing capital or even considering? And I think you kind of hit on some of these red flags. So I guess a couple, like two main questions that each of you would say if you were approached by someone, what is the two main things that come to your head to evaluate any red flags?
So
Mhm.
I know that I'll always remember being in finance class and my professor asking me, if this is such a good deal, why are they coming to you for $50,000? Why wouldn't they go to a bank and say, I need $1 million because I'm going to give you back 12, 14, 15%? Because normally that's what people are looking for when they get into a private equity is they want above market return. If not, I'll just go buy the S&P 500 and get 8 to 10%. I have liquidity. I have easy access to it. I can log in and see it. So you're going to demand a higher rate of return for the risk that you're taking. And then the question becomes, why do they need to go to a bunch of different individual investors asking for 10, 15, $20,000, $50,000? Why wouldn't they just go to Bank of America, Wells Fargo, US Bank and say, give me $1 million, I'll give you back 12%. And normally it's because the bank knows it's too risky. And so I'd always be careful with anyone who comes to you with that idea. It's almost always going to be, it's probably not going to make sense. Another part of it is how much of this portfolio does is that going to be? If I'm pulling 5 to 10% of my portfolio from a traditional investment mix, I could get into that concentration risk that Nick talked about, where now I just own one asset, and I hope that it goes because it's going to be fun. And ultimately, it comes down to greed. My friend got a great return. I want that same return. But now you've got 5 to 10% of your portfolio in one risky holding. And so, as Nick mentioned in the previous slides, there's other ways to go about it that diversify away some of that risk, give you some better liquidity, and now you've got transparency into where you're investing. So typically the ones from a friend coming to me and telling me this is a good idea, they're making money on it. I'm going to tell them it's probably not going to make sense because they're not going to be able to answer that question. Why come to me? Why not just go to a bank for the money?
Yeah, yeah. Those are all great points. And Bob's not here, so I get to steal his thunder. But he always talks about return on headache or ROH. He's like, is the ROH going to be high enough for me to go on this endeavor? And it's like truly though, it's like if you just earned 1% better than the S&P 500 did, like the last couple of years we've had double-digit returns in the S&P 500. So if you did 1% better than the S&P 500, would you be happy with that with all the additional risk and liquidity and everything else? It's like, or are you only going to be happy if you have like a 50% return? And so, you got to make sure that the return on headache is there and make sure the expectations around that are there too. So, that's a big metric. These are just more trade-offs and kind of can go into that question if you wanted like a list of questions to ask, like, what are the liquidity? What does that look like? Again, usually locked up pricing. What are the fees? Is there leverage? Is there, uh, you know, like how do I know what this thing is worth? Like, are there other people invested? Like, et cetera. And by the way, like kind of a sidebar here with all the IPOs, and one of the reasons that they're so volatile with IPO investing, and it usually doesn't go well for people in the first year, right? When you buy into an IPO these days, um, is we're switching from this pricing model of going off of manager marks, and basically only people are able to buy it in the private market. Nobody's really able to sell it. And then it goes on to the public market, and it's just this digestion phase of figuring out like moving from one pricing model to a different pricing model. And so that's a huge reason why there's big swings up and down. So anyway, that was just side note on IPO stuff specifically. But fees,
Yeah, I'll say
yeah.
to the fees point, Nick, a lot of
Mhm.
times the old way of doing business in the advisory world was very commission forward. And so what people don't know is advisors used to sell people individual private holdings, real estate investment trusts, master limited partnerships, present them the big fancy presentation. They would buy in, and that advisor would get 5 to 20% in commission. So they would push them hard because it was a commission-based world.
Mhm.
Now that we've got so much more information, access to information, you're not going to see as much of that, and you really shouldn't because the fees that are associated with it are super high. So always be wary of, how is someone getting paid who's pushing this product on me?
Yeah, absolutely. And it's like I can promise you the fees will be higher in private market land. I haven't seen one that's cheaper. So, transparency, you go from high to super low transparency, right? Like there's limited public data. You're not going to have an open line to the manager, management company, or the even you oftentimes won't even know the companies that you're investing in because they're private. They don't have to disclose, and the fund company doesn't have to tell you every single investment that they're doing. So it's very, very interesting there. Um, Behavioral though, when I pull up charts of like private equity or private debt funds versus public, the private funds have like almost no wiggle in the lines, right? And the reason for that is because even when public markets are stressed or they're wiggling daily, digesting all the information, that information doesn't get priced in or reflected, or if it does, it's on like a 3 to 6 month lag. And so the private stuff will always look more stable. That doesn't necessarily mean that it's just like actually a stable investment. It just means it's not reflecting the pricing daily, right? If you only opened your account 4 times a year, so you had 4 data points, it'd probably be a pretty smooth line. Versus if you opened it every day and you had 250 something data points, that'd be a very wiggly line. So that's a big difference there. Time horizon, again, public market stuff, we can do things for folks that have a 1 month time horizon down to, their whole life or 50-year time horizon. Private market stuff is like only for that super long term horizon and when you're okay to possibly never see those funds again. Taxes, we kind of talked about that already. So who can invest and who should? So there's a lot of it's a great question. So it's like, should I invest? Can I invest? In the fund world, there's this thing called accredited investor requirement. So a lot of those true private placements um, have this requirement. And again, it says it here at the bottom. The SEC requirement is a net worth of over $1 million, excluding the primary residence, or income over 200 to 300, depending if you're married for the last 2 years. So it's like you have to be wealthy, high level of income. Then the SEC says you're allowed to invest in this. And this whole rule is pretty controversial, and I promised I'd keep it under an hour, so I'm not going to get into that. But there are a lot of there's a lot of reasons that you get excluded from being able to invest in this, and so that's also worth considering. It's like if the SEC or the government says I probably shouldn't, or I can barely squeeze into this category, like does that mean that I should just do it? And so usually the answer there is no.
And
There's
and
a
I don't know
just
that
because
that
you
number has changed. That $1 million has changed in 20 years. So
yeah.
uh, a lot of times the salesperson is using it to say like, hey, the common people, they can't invest in this, but this is only available to you. You met the special category. So it's like, wow, I feel special. I should buy this. It's
Hmm.
like, well,
Hmm.
probably not. That's not the reason for it.
Yeah, no, absolutely. So just because you can doesn't mean you should. That's true with any investment, especially true with private investments. So,
I'll
all right.
also tell you that I sit on a couple of investment endowments and investment committees, and there is a slice of it, even in endowments and huge portfolios, but it's just not going to exceed more than 5-10% would be, outrageous. But, if you had a little slice of it because you wanted to stay tuned to it, as we get into planning lens, when does it make sense? That would be a unique way to do it. And not through a single investment, through multiple investments in it would be a way to get involved in it as an asset class.
Mhm. Yep, absolutely. So the planning lens, our mission, and I say this all the time, but our mission is to take the least amount of risk possible for you to achieve your goals. And even though I'm the investment guy and I'm like, no, we need maximum returns all the time. It's like, really, that's not what clients need. Like, we need to make sure that we're balancing the risk we take with the goals that you have. And again, these are just tools or complementary to a portfolio. They do not replace a core portfolio where it's like you should have all your money in this stuff. Like that is not at all what we would ever recommend. And then ultimately, the main purpose of this webinar is just to help you make more informed decisions, whether it's one of your friends talking to you about something, or if it's a true like registered investment vehicle that you're looking at. We want to make sure that you make the best choices, and we're here to walk that walk with you. So,
Yeah, and ultimately
um,
that's
yeah.
exactly right. So when you do have those friends come to you, right, give us a call, send us over the prospectus, whatever it may be. We can evaluate it and say, hey, we've seen this kind of noise before. I'd stay away from it. If it's something you want to add to
Mhm.
your portfolio, let's come up with a creative way to get you into there with liquidity, with less risk. Make sure you're informed of all those things before you say, hey, this is what I want to do. If you're doing it because you heard your friend got a 20% return and you want to be a part of that, that's where it's going to be probably hard for us to say, yeah, that's a good idea.
Hmm. Absolutely. So this is just one approach. This is kind of like the standard approach in our industry is this like core and satellite mantra. So a core portfolio is all those public things. Morningstar research and all that says you should have at least 80% of your assets in what's considered a core liquid investment and no more than 20% in one of those satellite things, whether that's a private or investment real estate or insurance or gold or cryptocurrency or any of those things. So that's just a useful starting point. Obviously, everyone's situation is different, and that number could be a lot lower, could be a little higher, but it's just kind of a base level framework of where to start the conversation as far as like position sizing if you're interested in something like this. So, all right. So talk about this a lot, the funnel as well, just kind of bringing it all together. The top of the funnel is everything there is to know about investing. And we want to show you that at Balance Wealth, we have access to the whole investment universe, right? The top of our funnel is really wide. We could do everything from private equity to private real estate to insurance to stocks and bonds, crypto, annuities, whatever it is. We can do it all, but we whittle it down to the investment ideas that our clients understand, trust, and align with your goals and values. So when I go to make an investment, it's important to cast a really wide net. Make sure you're looking at the full opportunity set and then whittle it down to what's right for you. And that's how we get to the perfect investment strategy. So that is our goal with all this. This is just another piece in the funnel. So any questions from the class here?
See any come through after, but I do appreciate those that were asking questions as we were going through the slides. I think that just helps. If you're thinking about it, I'm sure someone else on this webinar is and will be thinking about it when they send the recording. So I know we're kind of buttoned up close to the hour here. Um, I do want to mention a very popular webinar coming, kind of our halftime report. We will be doing July 15th, and we'll send out some RSVP links that you can register for that. But that's always an exciting one. A lot has happened. I can't believe it's already been, halfway through this year. But from inflation and interest rates to change in the Fed chair to the war to IPOs, there's a lot to talk about, and it's really exciting. So if you guys watch the recording, those that are on here, send us your questions. Make sure you join in. July 15th, it'll be a 1 o'clock Eastern time as well. So hopefully you guys can take your lunch hour and join us then. We'll be sending out the recording. But with that, any other final words, gentlemen? I appreciate your time today.
Well, appreciate everybody. Let us know. We can help. We're here for you.
Yep, yep. We're always happy to poke holes in things. So, send us what you got. We'll give you an honest opinion. We're a very impartial party here because we don't get paid from any of the investments that we look at. So, all righty. Thanks,
All right,
everyone.
got it. Thank you.
Yep. Bye.